right, Barry, it's been a great year. Where do we go from here?
Yeah, I know. I hate to be Debbie Downer, but if you think about it, the recessions tend to be high impact and low probability events. And there have been 7 recession-related bear markets and declines in the last 50 years. We think there's about a 20% chance of a recession in the next 12 months in 2020. And we would have to haircut the fair value by about 7%, probability times outcome. And that's about that's why our target price on the S&P, which is 3250 or so, is below the 3,500 value that you could get to at a 20 multiple at 0 real rates on about 175 consensus earnings, which is above our estimate as well.
I mean, so in your mind, the S&P is going to do nothing next year, even with a prediction of only a 20% chance of recession. How does that? How's that mess?
Yeah, we would like to see the recession probability recede. I think the market is underestimating the risk on the oil side towards mid-year. The Saudis will probably do anything it takes to get Aramco off their local stock exchange and onto a big board like London. And that requires higher oil prices and significant production cuts on top of what they've already done after they monitor compliance among the rest of OPEC, but in the March meeting. The second thing is Iran has maximum leverage to deal with the administration around the July 4th driving season. So towards mid-year, there could be trouble in the Strait of Hormuz. Also, the yield curve is a pretty good predictor of trouble, and we are at maximum consumer confidence as well. It's the highest it's been since 1999 and 69. So, again, we are constructive on sector rotation, and on October 13th, we rotated from being defensive, where the market had been flat for about 600 days, point to point, from late January to early October. And we rotated to a cyclical profile: energy, materials, industrials, technologies, and financials. And we're going to stay with that long-short cyclical to defensive ratio as we go into 2020.
Jim, I think that's a key question. I wonder, at what point do investors start to really hone in on the geopolitical risks out there? I mean, you have folks storming the embassy in Iraq right now on the heels of those U.S. precision strikes over the weekend. We've seen protests flaring up and in many cases getting more violent and bigger in many parts of the world right now. All of these simmering tensions with Iran overall, North Korea, I could just go down the list right now. Does any of this begin to impact the market and how investors are thinking about where they're putting their money?
No, it does not. Not unless and until there's enough of an impact in one of the regions you just mentioned to spill over and have lasting economic impact. Will it have a market impact? Investors basically have become rightly skeptical of all the theories that draw from headline risk events. And I think as you go into 2020, just as in 2019, it's going to be very important not to let your investment decisions be driven by either fear or fear of missing out. Equally as important, don't let your political views get in the way of your investment goals. The reality on the ground is that all of those risk events that you're talking about could, any one of them and or more than one of them, spill over into the marketplace. But it would take, I think, something quite dramatic. The most dramatic thing that we see on the screen that we know is going to take place in 2020 is the U.S. elections. I wouldn't be surprised to see some very volatile street protesting going on inside the U.S. as we wend our way up to and through that election. I think the 2020 U.S. election is the biggest risk with the greatest unknown outcome that 2020 investors face.
All right, so that begs the question then, if you don't want to invest based on fear or fear of missing out, where do you put your money?
Well, first of all, you follow the fundamentals. With the Fed in the corner and the consumer doing very well, I think you continue to focus on the things that drive the market for long-term investors. Those are earnings, interest rates, economic data. If we begin to see cracks in the consumer, if we begin to see cracks in earnings, if we begin to see the Fed do something unexpected, then, of course, we'll reassess. But right now, we think the most prudent approach to 2020 is the approach long-term investors should always take: a disciplined, diversified approach with a good mix of both equities, bonds, and a little bit of cash, not just as a buffer, but also to take advantage of dips.
Barry, we basically had this relief rally over the last few months when the market realized, hey, a 2% economy is not so bad. At what level of the S&P do we have the realization that, hey, a 2% economy is just not quite good enough? Is that a dynamic we're going to be facing at some point next year?
Yeah, there's no question that the Fed engineered a rise in the price-to-earnings multiple of the S&P 500 by driving the real interest rate back down to the level of inflation. So you've got about a 1.55% Fed funds, and you've got about a 1.5% core PCE deflator. As a consequence, your PE multiple is approaching 20 times as a fair value, or full value, I should say, for 2020. The street is looking at $175 of earnings this year coming up. We're about almost $10 below that, but the market's going to price off the consensus. In that case, you could argue for 3,500 for the S&P if you believe there's no chance of a recession in 2020. And that is the big question. Will there be a catalyst for a recession in 2020? And how much do you haircut the market based on those probabilities?
Barry, what do you think earnings are going to be in the year ahead? Earnings growth. I mean, that's going to determine whether stocks, quote unquote, deserve to be at the levels they are.
Exactly. And one of the reasons why your previous guest had said that the market had somewhat limited upside in the previous show was because the earnings growth would only be about 4 or 5% in a optimistic scenario for 2020. As a consequence, at a very full multiple on earnings, you have very low single-digit, maybe mid-single-digit potential gain. Again, if you can avoid a shock, a recession, and all kinds of mayhem that we all fear. So we're climbing that wall of worry right now.